I think historically, when you look at the three markets, there's pretty high correlation between the three big markets and developed markets. But right now, we think that the U.S. is basically going to outperform Europe, and Japan's going to outperform both markets. First of all, the weak yen still contributing to a lot of the earnings upgrades that we're seeing in Japan, and QQE will likely be increase basically in the second half when you see inflation target is falling behind the Bank of Japan's previously projected path. So that's a positive for Japanese equities.
A lot of the people who cite the months to come in Japan as a reason to stay engaged in Japan, it sounds like a stretch to me. The latest figures on household spending and consumption were a little bit disappointing. I mean, that has not really been a booster rocket for the markets, but in talking to them, they say, the spring wage talks are, haven't totally finished yet. And when people get better paychecks, they're going to go out and they're going to go crazy and go nuts after that. And that's going to really be the underpinning of the Japanese market. I mean, we've seen that even in the U.S., when you get a windfall because of lower oil prices, the tendency nowadays is debt abatement rather than to go out and spend on instant gratification. I mean, the Japanese, you would think, are even more inclined to do so than Americans.
Well, that's a phenomenon that we've been seeing. I guess the failing part of Abenomics so far in the past 2 years is that consumer demand hasn't really picked up. That's because what we've seen is that real wages haven't really grown. So nominal wages have grown, but adjusted for inflation, that hasn't grown. And that's a key component to drive consumer demand. But the good thing is that we've seen a pretty significant pickup in the business sector in the first quarter. Capital spending is picking up. And hopefully the next round is that businesses are more willing to spend first on capital spending and next on wages and hiring. So that should eventually channel into the consumer's market in Japan, which really makes up around 60 to 70% of GDP, which is pretty important.
QQE, you expect that to be expanded?
That should be expanded. The BOJ is turning more dovish and turning more, I guess, cautious in terms of reaching their CPI goal in the previously projected time frame. So when they get closer to the deadline, they will be expanding the QQE, and falling behind inflation would be a key reason to that. In
your view, what leads the market up then, if this market keeps forging ahead?
Well, right now, initially, we should see more earnings upgrades, especially with the yen so weak right now. So export sector earnings will be revised positively by analysts. So that should drive the Nikkei higher. And subsequent to that, as we move into the second half, higher QQE expectations will be driving equity valuations higher.
Why are we talking about Japan when the real fun is over in China? Isn't it? I mean, if you can stomach the volatility, you've already made 50% in Shanghai this year.
Well, yeah, pretty easily if you can live through the volatility. But right now we see it's still a liquidity-driven market in both Shanghai and Shenzhen. And in the past couple of weeks, we've been seeing more weakening signs in terms of the internal structure, in terms of the liquidity. We have seen account openings are dropping. So what you see is that there are less and less new investors opening accounts, getting their money, real money, into the equity market. But instead, the old investors that have been in for the past 12 months already now keep gearing up. So that's not a good sign. And we expect some pullback in the equity market in both Shanghai and Shenzhen. Double-digit decline is possible.
A lot of people have been excited about the prospect of MSCI EM index inclusion in a week. I don't know, but do you think it is? And will it happen this time? If it doesn't happen this time, it's inevitable that it's going to happen. And when it does happen, that means a lot of the EM funds, including the ETFs and the index funds, they have to buy. They have to go in. It's an automatic mechanism, isn't it?
They have to. Eventually, this will happen, and this will be exciting. But what's holding?
But not this time.
But what's holding the funds up right now? It's really the legality of buying A shares through the Stock Connect program. A lot of because of the nature of how the fund is set up legally, they can't really buy the A shares even through the Stock Connect. So when you have these fundamental regulatory-related, legal-related barriers removed, having them included in the A shares, including A shares in the EM index or other indices is not really going to drive that demand yet.
Yeah, well, that's why inclusion in the MSCI EM index would be a relatively small proportion anyway. So there's not going to be a huge amount of fund buying in China, I think. Hey, what do you do for fun? Do you do anything for fun?
What do we do for fun?
Do you crack a smile at all? Sometimes.
Yeah, sometimes.
How about these days in the markets?
Well, these days in the markets, we spend a lot of time still, reading, going through a lot of numbers, a lot of things. Right now, we're pretty concerned on the Chinese economy still. We've seen 5 PBOC easing since November, 3 rate cuts and 2 triple R cuts, and we still see more down the road. And we haven't really seen significant signs of the economy picking up, so we spend a lot of time looking into that.